What if I told you your bank doesn't store your money the way you think it does? So where does the money in your account actually come from? In the next 10 to 12 minutes, I'll explain the simplest, most useful model of modern money. No conspiracy, no jargon, so you can think clearly about debt, savings, inflation, and your personal financial safety. Today's topic: how banks create money when they lend, how money gets destroyed when loans are repaid, and the practical rules you can use this week to protect your purchasing power and build real wealth. Let's start with a reality check. When you open your banking app and see a balance, what is it really? Is it your cash sitting in a box somewhere? Or is it a claim, an IOU, that your bank owes you on demand? Here's the key idea. In modern economies, most money isn't cash. It's bank deposits, digits on screens. So question 1. When a bank approves a loan, where does that money come from? Most people imagine banks take other people's deposits and hand them to you. But in the modern system, lending usually creates a new deposit. Think like an accountant for 15 seconds. When the bank lends, it records your loan as an asset because you owe the bank money back over time. At the same moment, it records a deposit in your account as a liability because the bank now owes you that deposit on demand. One new loan creates one new deposit. This is the money out of thin air moment people talk about, not because it's fake, but because the backing is your future cash flow. Now the next question. If banks can create deposits like this, what stops them from creating unlimited money? 3 constraints. First, risk and profitability. Banks don't want you to default. They want loans that are likely to be repaid and priced to cover risk. Second, regulation and capital. Banks must hold capital against their assets. They can't expand their balance sheets forever without limits. Third, liquidity and settlement. When deposits move between banks, the system needs settlement, and banks must manage funding so they can meet payments and withdrawals. So yes, banks create money through lending, but they are constrained by reality. Now here's a question that changes how you read economic news. If loans create deposits, what happens when you repay a loan? The deposit shrinks. Money is destroyed in the deposit layer. That's why credit booms feel like money booms, and credit slowdowns can feel like money disappearing. Let's make it concrete. Imagine you borrow £10,000 for a car. The bank approves you. You don't walk out with a bag of cash. Your bank account balance increases by £10,000. You buy the car from Sam. You transfer the money. Sam may bank elsewhere. So here's the next question. If your deposit moved to Sam's bank, does your bank lose money? Your bank must settle. Banks settle payments between themselves using central bank reserves. You don't use reserves to buy groceries, but banks use reserves to complete interbank transfers. This is why the plumbing matters. Lending creates deposits, and then the banking system adjusts through settlement, liquidity management, and funding. So when people say, banks lend out deposits, it's backwards in the important way. Deposits often follow lending. The loan creates the deposit first, then the system manages the consequences. Now ask, what happens when many people borrow at the same time? Deposits expand, spending tends to rise, businesses sell more, employment may improve, until capacity constraints, bad lending, or speculation appears. And what happens when banks suddenly become cautious? Loan growth slows, deposit creation slows, spending slows. That's one reason recessions can feel like the economy hits a wall. Here's a retention question. Why do interest rate hikes often feel slow at first and suddenly painful? Because debt servicing costs creep up, refinancing becomes harder, and eventually borrowing and spending changed sharply. Now we need to clean up a confusing word: printing money. When people say they printed money, they often mix different channels. Printing cash, physical notes, is one thing and relatively small. Government deficits, spending more than taxes, are another channel. Central bank asset purchases, often called quantitative easing, are another channel that mainly affects reserves and financial conditions. Commercial bank lending is the everyday channel that creates deposits directly in the real economy. Different pipes. They can interact, but they're not the same. So here's a useful question. When prices rise, is it because of supply shocks, energy, fiscal spending, or private credit growth? Different causes require different responses. Now let's connect this to your life. Why do house prices sometimes rise faster than wages? One reason is where credit flows. If a lot of new lending chases scarce assets, especially property, then deposit money expands and prices can rise faster than incomes. That's not the whole story, but it's a key mechanism. So question, in your country, does bank credit mainly fund productive investment, or does it mostly fund existing assets like housing? Because the outcome is very different. When credit funds productivity, tools, training, businesses, you can get growth that raises real wages. When credit mainly bids up scarce assets, you can get asset inflation, inequality, and fragility. Same mechanism, different results. Now, quick history in plain English. Older systems often tied money to scarce commodities like gold that can feel stable, but it can also make money too tight when the economy grows. Modern banking evolved partly to create elastic money, money that can expand with economic activity. But that flexibility creates a new problem: cycles. If lending standards drop or credit flows into speculation, you can get bubbles. When the cycle turns, you get painful contractions. So modern economies build guardrails, regulation, capital rules, supervision, deposit protection, and central bank policy to influence credit conditions. Now, what should you do with this knowledge personally? Rule 1. Understand what your bank balance really is. In normal times, it's a reliable claim you can spend instantly. In stress, it's still a claim. So your safety is about structure, not panic. Practical step: don't be fragile. Keep a buffer that buys time. Rule 2. Treat debt like a system, not a lifestyle accessory. Write down every debt: interest rate, fixed or variable, reset date, monthly payment. Ask, what happens if rates rise, or if income drops for 90 days? Because in a credit-based money system, interest is the steering wheel. If you ignore the steering wheel, you'll feel like the economy and your life is random. Rule 3. Think in real terms. A 5% raise with 6% inflation is not a win in purchasing power. A 4% savings yield with 5% inflation is still a loss. Now, safely and neutrally, a 2026 tool. And in 2026, one helpful tool is AI assistance, used as a co-pilot, not a decision maker. AI won't predict markets like magic, but it can help you map your personal balance sheet, run scenario checks, and summarize primary sources without doom scrolling. Use it to ask, what's my interest rate exposure? What happens to my cash flow if rates stay higher? Summarize what changed in the latest central bank statement. The rule stays simple. AI organizes your thinking. Your judgment stays in charge. Quick check. Did this make the money system feel simpler? If it did, drop a like and comment yes. If you already knew banks create deposits when they lend, That helps me pitch the next episodes at the right level. Let's close with one mental model you'll remember. Modern money is mostly credit. Credit runs on trust. Trust runs on resilience. And your personal resilience comes from clarity, buffers, and adaptable skills. So your mini checklist for this week. List debts and interest rates. Build a buffer that buys time. Invest in a skill that raises earning power in an AI economy. Sources, spoken plus on screen, fully written. Bank of England, United Kingdom. Quarterly Bulletin, 2014 Q1. Money Creation in a Modern Economy. Michael McLeay. Amar Radia. Ryland Thomas. Bank for International Settlements, BIS. BS Statistics. Credit to the non-financial sector. Long Run Credit Series. International Monetary Fund, IMF. Global Debt Database, Data Portal and Documentation for Debt Concepts and Measurement. Reward for the people who stayed to the end. The real secret isn't that banks create money. It's that you can design your life to be less dependent on easy credit while still using the system intelligently. Stay aware, stay adaptable, stay curious. Final question. If you had to choose, should cheaper credit go to mortgages or to businesses that raise productivity and wages, and why?